Okay, folks. Well, hey, this is Kurt Frankenberg coming at you, not live now, but in a recording from my home in Monument, Colorado, and it's May 19th, 2015. Earlier today, I attempted to do another episode, another class for my radioactive trading folks, and it didn't work out. The sound was not good. So this is not going to be an interactive webinar. Like normal. It's going to be just a recorded class, okay? And you can certainly still send your questions to me at support@radioactivetrading.com. But let's go ahead and get started, okay? Whenever I'm looking at a new idea, whatever that new idea is, I ask myself this question: is this for me? And in the email that I used to promote this class, I promised a few things. For example, how to protect yourself from loss, how to take income from your stocks using more than one way, more than, for example, just dividends or the tired old dust and mothballs covered call play. Okay. Also, how to participate in growth, which covered calls does not allow you to do. And how to essentially bulletproof your stock and no longer have risk, but still have upside potential. And while that doesn't always happen, it does happen often enough that we call it commonplace around here. Okay, so we're going to feature the RPM, or radioactive profit machine, which is a kind of a new take on how to do a married put. Okay, it's a unique variation of the traditional married put play. And we'll be featuring income method number 5 of the 12 income methods. This is one of my favorites. It isn't my current favorite, but it is one of my favorites. I like it because it's a spread trade that's riskless. You heard me right. It is a spread trade that is done at a credit and may actually be closed at a credit. You open it at a credit, then you close it at a credit, but doesn't pose any capital risk of itself. This creates income, but doesn't necessarily limit your upside growth potential because it's a near-term play, and once it's finished, your longer-term play is still in place. And you'll understand this as we get through the class, okay? So this webinar is going to introduce you to a new and better way to trade that actually practices this idea of cutting losers short and letting winners run. Okay. Oh, and yes, you can get paid while doing it using one or more of the 12 income methods. Kind of cool. So more important than all this, let's talk about you. Now, at this point, normally I was running a poll. I tried to run a poll today. It didn't work out. We ended up stopping the webinar about 20 minutes in. Okay, so I was going to ask some folks to share their trades and compare those results. But you know what? You can go ahead in the privacy of your home. Check out what I'm going to share with you, compare that with what you've been doing, and see if indeed the radioactive profit machine would beat covered calls 2 different ways, if it would beat stock ownership, just straight up owning a stock, and if riskless spread trades are not a part of your repertoire right now, you might consider, well, geez, I kind of like this idea. I like the idea of not in introducing risk, but still having a premium capturing play. Okay? All right, so for most of us, what is the problem with our trading? The problem is not making enough when we're right, but more importantly, not losing too much when we're wrong. Okay? That's the big deal. And here's a quick introduction of me, okay? I'm called the champion of married puts, not necessarily because I'm got some kind of designation, some kind of win in a competition with married puts. I suppose if there were competitions, I would enter. If there's a competition for trading married puts, I would do it. But champion also means the person that speaks for the cause of another. Okay, and so that's me. That's my ugly mug. That's Kurt Frankenberg. And what I'm all about is teaching people about this little understood and even less practiced strategy of how to keep yourself out of trouble while at the same time leaving your upside completely open. Now, here's a good question. We had a question earlier, and that was, is this for me? And so now this question is, why should I listen to this guy? Why should I listen to Kurt Frankenberg? Well, remember, I said I'd tell you why I'm called the champion of married puts. And it's a little story that goes kind of like this. Back in the late 90s, I went to the sit-down Cheeks and Seats seminar of a man named Wade Cook. He was doing a seminar called Zero to Zillions. He had made millions in real estate and then made more millions in real estate seminars. And then he went on to become the biggest voice and pretty much the trendsetter, the person that set the standard as far as the information side of this business. He was the gentleman that introduced the idea of taking monthly income from owning stock and doing spread trades. He was talking about monthly income from spread trades and from covered calls. And I followed the advice and I bought stocks. I sold calls against. I got called out. But the big one was this trade with Lipo. Okay, now Lipo no longer exists. It got bought out by one of the big pharmaceuticals. I think it was Bristol Myers Squibb. It may have been Johnson & Johnson, but somebody bought them. All right. It was trading at $17 a share, and what I did was I sold the $20 calls about 6 weeks out. Okay. Now, if you don't know what a covered call trade is, I'll briefly describe it here. $3 per share was paid to me, or $300 per contract that controls 100 shares, for me to hold and just sit on that stock. Now, the person that paid me that amount is a speculator. He believes that Lipo is going to go way, way up, and he would like the right to buy Lipo at $20 a share and sell it for, whatever, for $27 or $30 or $50 a share, whatever he thinks it's going to go to. Meanwhile, I'm the one sitting on the risk. Okay, so all he risks is his $3, and I am sitting on the risk where I bought into the stock. Now, here's what happened. Okay, I'm thinking that I'm going to do what I've been doing. This is the late 90s, remember, and everyone's a genius in a bull market. So I was a genius. I was going to make $3 profit on the stock, and I was going to be able to keep that $3 premium. Okay, so the person that I sold the call to, the person I sold the cover call to, was going to be real happy because they've got a stock that's trading over $20, and they only paid $3 to control it. All right, and then I'm going to make the $3 move, from 17 to 20, and I'm going to also keep this $3 premium. And so that's a $23 in for every $17 that I put out. And in 6 weeks, that would be a 30% gain. Well, you're probably starting to scratch your head. If you are a covered calls trader, you're probably realizing that this deal is a little too good to be true. And it was. I was heavily margined. I'm billing myself as a covered call genius, but actually, no, I was not. I got hurt really, really badly. Now let's count up the cost. Okay, here's what happened. I went to a weekend covered call seminar where I learned how to trade covered calls. I bought the software that they had there that was also being hawked as a way to kind of tell what was going to happen with the stock. But the real education that I got from the market was even more expensive and more useful too. Nobody ever taught me how to keep out of trouble, and because of that, I got hurt really, really badly. But rather than blaming others, rather than blaming Wade Cook, rather than blaming the market, rather than blaming the person to whom I sold the covered calls, or the person from whom I bought the stock, okay, I realized that it was my behavior and my fault, all right? But mathematics was the key to understanding how not only could I have protected myself in this situation, but I actually could have possibly come out a winner. You see, Lipo was back up to full strength about another 4 months later. There was a catastrophic news announcement. The Lipo was a cancer-fighting drug, all right, and it was in clinical trials and so forth, and it missed its FDA approval, but then later got it. So while I'm doing this play, I got into trouble. But if I had just made the margin call, if I had stayed in Lipo, it was back up to full strength and better by 4 months away. All right, and I realized, you know what? If I had been able to kind of somehow armor myself against that loss, I might have been able to stay in and end up making that play a winner. And I accidentally figured out how to control risk to an extreme degree, while at the same time putting to work an age-old mathematical concept that the casinos use against you and me. Okay? And that mathematical concept is the concept of edge. Okay? Now, I'm going to take a second here, and I'm going to give you a quiz, and the results may surprise you. And the whole point of this is to show that most people don't understand how math works, including me. When I saw this, I got a little bit shook up because my reality was assaulted. All right? But what I'm going to be doing here is giving you the key to successful trading in 2015. Now, here's the math problem. Okay? Here's the math problem. Goes like this. You are in a race car, and the race car goes once around a 1 mile track at 30 miles per hour. Okay? Your race car goes once around a 1 mile track at 30 miles per hour. Okay? So, how fast must it go on the second lap for an average speed for both laps of 60 miles per hour? Now, I pose this question live, and the most common answer that I get is 90 miles an hour. All right. A lot of folks will look at that and they'll say, well, that's easy. You know, if you go 30, your first lap, then 30 plus 90 equals 120. Divided by 2 equals 60. And so that's how you do it. You just simply speed up and go 90 miles an hour for your second lap, and you'll get there. Okay. Well, surprisingly, that answer is incorrect. And I also got a live answer today, in fact, before we just had to can the webinar, okay, because of the bad sound problems. I got another fellow saying 120 miles an hour, and another fellow saying 150 miles per hour, and another fellow saying, hey, there's not enough information to answer the question. Well, here's the deal. It's a trick question. There was enough information, but the answer is it can't be done. You can't possibly move fast enough for your average speed for both laps in this example to be 60 miles an hour. Okay, now that may seem a little weird, but let me go ahead and explain. You see, 60 miles an hour is a mile a minute, right? And so the average speed for 2 laps being 60, that would mean that you would make both laps in a total elapsed time of 2 minutes. Okay, so if you make the first lap in 1 minute and you make your second lap in 1 minute, why then that would be an average speed of 60 miles an hour. But see, we did something foolish. We drove our car for 30 miles an hour for the first lap. And 30 miles an hour, as you know, is half the speed of 60. And therefore, it would take 2 full minutes to make it around the track once. Now, we have no time left. We've used up our 2 minutes, and so we can't possibly ever get to the place on our second lap that our average speed for both laps is going to equal 60. Do you see that? All right. Now, why does that have anything to do with investing? Well, I'll tell you. Most of us in our investing career and our savings and planning for retirement, we're on our first lap, aren't we? And we may find before our productive working days are over, we may find that we are traveling too slow right now and are not going to have enough to make the second lap work out for us. Wow, that's a sobering reality, but it's true. Well, let's go back to the stock market now, okay? Once I embraced this fact that the big problem that got me into trouble was not understanding mathematics and how it related to the market, I learned how to apply sound mathematics with some practical strategies. And we're going to take a look at them. And we're going to show the key to putting yourself in the seat of the folks that have the advantage in the market. Okay? I became a winner in the stock market, but it's not all about me. You're probably wondering if I can help you with your trading success, okay? And at this point, I would normally do another poll where I'd say, hey, what was your results last year? And usually when I do that, I do a spectrum, rather than I won or I lost. And the spectrum is this. It's man, fantastic. I'm doing so well, I can barely believe it, okay? Or, I'm making money, but not enough. Or, hey, I'm about flat. Or, "Ugh, I'm losing money. I hope that some tips from today will help." And then finally, I'm hemorrhaging cash, and I'm ready to quit. Okay, so of those 5 answers, we almost always get all 5 categories filled out. Where do you think the majority of people are? I'll tell you where the minority is. The minority is, hey, I'm doing great. I'm making money hand over fist. That's the minority. Usually we have 5-6% in there. And then we also have 5-6% in the I'm hemorrhaging money so badly I want to quit. We usually don't have folks that are doing so poorly, or maybe they are doing poorly but they don't want to quit. But actually where most people are concentrated is I'm losing a little or I'm flat. We don't have a lot of folks that are winning. And what I would like for you to do is consider where you are in that spectrum. Now, even if you're in a place where you're winning, I think I can improve your results. And if you're in a place where you're losing, I think I might be able, with one tweak, to be able to turn your trading record from a losing record into a winning one. And, see if I'm right. Okay? All right. So here's my good friend Mike Chukka. Mike Chukka is now the Director of Options Education at Power Options, and he introduced me and Ernie Zerenner, the inventor of Power Options, in 2007. I'll be showing a little bit about Power Options tools later in the class, okay? Now, Mike, because he's a very advanced options trader, has tried all kinds of different strategies. He's done double diagonals, he's done condor trades and vertical spreads and time spreads and all kinds of crazy things, including naked puts and covered calls and just about any options trading strategy that you can imagine. Mike has done it, or he's simulated it. For example, short straddles are an extremely risky play. He's simulated, but he hasn't actually gone there with his own money. Okay. Now, Mike told me that he had done the best options play he had ever done in his life was a time spread where he bought a call far away in time and sold near-term calls against it. Okay. That was one of his most profitable strategies ever. But on the flip side, it was also his most devastating loss ever when he continued to trade that way. Kind of reminded me of my story where I was doing real well with covered calls and then I got killed, okay? So Mike reluctantly, when he first saw my setup, the radioactive profit machine, he said, I don't know if that's going to work to make money. I mean, I see what you're doing. You're keeping your risk low, but I don't think you can actually make any good money with that. Well, later on, we'll take a look at some of Mike's results, but at first he was pretty resistant. Later on, though, he decided that he was going to trade radioactively, and in 2008, being long stock the entire year, he posted a 1.5% loss. Now, I know that most of you are not tuning in to learn how to lose 1.5% over the period of a year. But get this. Apple Computer began that year with about $200 a share and ended that year with about $88 a share. So a 56% loss. And it's not that Apple was a bad company to be in at that time. You see, Apple actually had its banner year, biggest year ever, posted over $6 billion in profits, over $3.5 billion profit the year before. All right, so Apple was making money for itself very well. It just wasn't making money for its shareholders. Why? Because the whole market was going down. And when the whole market is going down, people are bailing out of Apple, even though it's a great company. Well, anyway, Mike was in a number of different stocks at that time, and he ended up closing the year with a 1.5% loss, compared with the S&P, which suffered an over 35% loss, or most mutual funds, 40, 45, 50% loss. Now, since 2008 closed, with 98.5% of his marbles left, Mike was able to buy in at the bottom, wasn't he? He was able to be long stock, and he has been long stock for the last several years and has done double-digit gains every year. 6 years closed out, and he's on track to have double-digit gains here in 2015 also. Okay, so pretty good. Mike was able to get out of losing and turn it into winning by using my strategy, and I think you might be able to as well. Whether you're winning or losing, I think you're going to be able to do better. Okay, now I promised some math, okay? Happy day. I know most of you probably aren't into math, and I'm just kind of the exception to the rule, I guess. I'm sort of a geek, okay? But gambler's ruin, or the Martingale Principle, is how people lose money both in games of chance and in the stock market, okay? But understanding how it is that the folks that are getting ruined, understanding how they get ruined, is going to be our key to learning how to get it right, how to not get ruined, all right? Now, the Martingale Principle, also called gambler's ruin, I've personified here. I've turned him into a character with dollar bills for scales, or dollar signs for scales, and he's eating money. He thrives best in an environment of charged up emotion. If you fear loss, or if you're too greedy for gain, or if you're just too complacent to really stay on top of your finances, you're going to get beaten and eaten by the Martingale. His plan of attack is simple. Each loss that you have creates an even more desperate move to regain lost ground. And here's how the math works. Let's say that you begin with $10,000 and you suffer a 20% loss. A 20% gain is not going to bring you to break even. You'd think that it would, but it won't. Let's check it out. $10,000 minus 20%. 20% of $10,000 is $2,000. So we're going to be brought to a total of $8,000. Now, when we take our $8,000 and play it for a 20% profit, that's going to be $1,600. So our account will be back up to $9,600, but it won't be back to $10,000. We have lost 20% and made 20%, and we're still behind the curve. It also works the other way around. If you gain 20% first, pardon me, if you gain 20% first and then lose 20%, it would work the exact same way. Okay? So what really works here is if you lose 20%, you're going to need a 25% gain to get back to where you started. All right? So that's the way that the Martingale Principle works. Now here's kind of an expanded scale. You see, once you lose 20%, you need a 25% gain to get back to where you started. But if you have a 25% loss, you're going to need to risk 33% and try to get that back. Okay, and the 33% loss, you need a 50% gain. And think about it: if you lose half of your account, if you have a 50% loss, you would need to double your money, or 100% gain, to get back to where you started. Okay, so as your losses progress in a linear fashion like this, all right, your amount that you have to gain back in order to get to where you started progresses in a geometrical or exponential fashion. All right, and let me clear out all this mess in here in between. And what I want to do is ask you a question. If a 50% loss requires a 100% gain to get back to where we started, then does a 5% loss need a 10% gain to get back to where we started? Strangely, no. Strangely, no. A 5% loss needs only a 5.26% gain to get back to where we started. And here, normally in the presentation, normally in the class, what I do is I ask folks, hey, what do you think about this game? Could you do this? Could you get a win? I'm going to go into radioactivetrading.com now. Could you win by playing a game that goes like this? Here we are on the Trade Simulator tool, and if you'll give me a second, it'll fire up. Let's say that you had a leveraged play where whenever you're right, you make 100%. Ooh, okay. But when you lose, all you lose is 50%. Okay, so let's say you bet $1,000. You could double your money and have $2,000 after. All right, but if you lost, well, you'd only lose 50%, so you'd have $500 and you can play it again. Now that sounds like a sweetheart deal until we realize this. What if the probability of a loss is greater than 50%? Okay, and we'll start with, let's say we start with $1,000. All right, and no matter how much we have in our account, we bet the house, okay, or we bet the stack. Okay, so let's do this. This is going to be a oh gosh, we lost all of our money in just 2 trades. Okay, so just a few trades. Let's try this again. Oh, geez, we're bankrupt again. You know what? Maybe we need to start with more money. Let's do that. We'll start with $10,000, And there we go. Okay, it takes us a little longer to go bankrupt now. So we have, what happens is once your balance goes below 250, it considers you bankrupt. That's why 2 losses in a row was all we needed before. So the balance is below 250 here at the end. Look at this. We started out with $10,000, and we had a few wins at the beginning and doubled our money and doubled it again. We're up to 40 grand. We might mistakenly believe we've got a winning system. But then after a few losses, now we get hurt. You know, sometimes, I'll just run this a few times because it's random. It uses this 60% probability. I'll run it a few times, and look at that. Okay, we're bankrupt after 20 trades. This time we had enough wins, so we rolled it up to 80 grand, and this time 40. Wow, we're going to just get hurt. Okay, all right. Now, let me go ahead and change one thing about this. And all I'm going to do is change how much I use of my capital. Instead of 100% of the capital, I'll use only 10%. Oh, okay. So here we lost a lot more than we won. Okay, we lost a lot of times. 66 out of 100 times. And started off with a string of losers. Look at that, a whole bunch of losers. And we still ended up taking our $10,000 down just to 8,600. Let's use less. We're going to risk less of our capital. Let's try that. Hey, even with a seriously losing record, now we've turned it into a net win. Isn't that something? And here's another losing record where we lost more often than won, but still was able to take our $10,000 and roll it up to $13,289. That's a 32, almost 33% gain. Kind of cool, right? All we've changed, the only thing that we've changed here is we've changed how much of our account we're willing to risk. Take a look at this record. Still with more losses than wins. We took $10,000 and nearly doubled it. All right, how about that? So that's the idea, okay, that I wanted to show you. I'm going to show you the practical on this. All right. Normally, what I do is I quiz my audience. I ask them, okay, we've got the Martingale here, and what if we had a game like this where you could lose only 50% when you lose, but double your money every time that you win, but you win half the time or less than half the time? You would never get ahead because you wipe out your gains so easily. You'd never get ahead if you bet your whole stack. But if there was a way for you to limit how much of your stack you bet at one time, why then, scaling it down by 10, you could be playing the same stocks and having the same record, but you would compound your winnings quicker. Okay, now that's just a math demonstration. We're going to show the practicals here in a minute, but that's a math demonstration of how to introduce skew. And skew, mastering skew, is the first goal to trading successfully. And you want to skew yourself because if you don't, you will screw yourself. We want to take the martingale out of this equation. And to do that, what we've got to do is we've got to learn exactly how to scale our account and bet only the right amount. Not bet too much, and also not bet too little. Betting too little is another cause of failure. Okay? All right, so here's the practicals. Okay, I promised you the rate active profit machine, or RPM. I'm going to go ahead and show it to you. This skews your reward over risk. Now, here's a quick overview of how mixing stocks and options works. The dotted line there is our cost basis on our stock. Okay, so the stock can go up. It could also go down. Up there in the right corner is the stock doubling, perhaps. And down there in the bottom left corner is the stock going to zero. Okay, so we lose it all. Instead of lose 50%, we could lose it all. Okay, not cool. All right, now, one way that folks hedge their stock is by doing this. The dotted line, again, is the cost basis. And what we're doing is we're reducing the cost basis by taking a small premium, like I described before, taking a small premium, and now we'll redraw the line here. Instead of 0, now we could lose all but 3%. Okay, because we've accepted a 3% premium that we get to keep no matter what. Well, now our cost basis is reduced by that 3%. Okay, here's the problem. 6% is all we can make. All right, if the stock goes up a little bit and we keep our 3% premium and we keep our 3% gain on the stock, all we can make is 6. So we're going to probably get hurt this way if we don't have our stock going up all the time. We also don't get to participate in the big rewards if the stock does go up. Okay, so I got this crazy idea, not so crazy. Instead of reducing the cost basis of my stock, I'm going to actually add a tiny bit. I'm going to buy stock insurance, and I'm going to use that stock insurance to limit how much I could possibly lose. But my upside potential remains. So now we're spending maybe 3 or 4 or 5% on stock insurance. Well, what does that do? Well, I'll tell you what, the upside is still unlimited, but the downside has now been severely curtailed. Okay, the upside is still unlimited, like with a stock play, but the downside is what's being curtailed. And that is a way to practice that trader's maxim of cut your losers short and let your winners run. Okay? Now, if a stock has, each stock has its own volatility signature. Okay, Apple trades differently than Netflix, trades differently than GE. Okay, so depending on how volatile your stock is, let's say that it has a potential of moving up or down by 15%. Now, as we saw before with the Martingale, if you're right half the time and your stock goes up by 15, but then the next play the stock goes down by 15, 15% gain and a 15% loss does not equal break even. You're going to be behind the curve break even. Okay, but by practicing that position sizing idea, we're going to introduce skew. Now watch how we do this. What we're going to do is take our cost basis on our stock, and we're going to change it a little bit by using the put option. Now, what happens is maybe we're going to cut into our profits a little bit. Instead of 15%, it cuts down to just 10% because we spent 5% on our put option. Okay, all right, fair enough. But what about the losing side? On the losing side, we can't possibly ever lose more than 5%. Okay? Now, introducing this, we still could have the same record of wins and losses, still could have the same record of how often we pick a winning stock. All right, but we might be able to change a losing record into a winning one. I'm going to ask you to consider your record. How many times, if you play covered calls, how many times do you think you would have made more money if you simply sat on the stock when it was a winner, rather than selling a covered call and having it called away from you? But more importantly, how often do you think you would have done better if the stock, even if it went down by 50%, but your loss was only 5%? Okay, let me put it another way. If you took no more than a 5% loss in any position that you played last year, would it have changed your record for the year? Most people say yes. Many people say it would have changed a losing record into a winning one, and others say, hey, I did well last year, but I would have done even better with this idea. Here's the practical on it, okay? About a year ago, Mike Chukka, the fellow that I showed you earlier, gets into CAR. That's Avis Budget Rentals, the rent-a-car agency. And their stock symbol is CAR. How about that? All right. So the stock price was $49.45. And what Mike did was he bought a put option clear out to the next year. Clear out till this year, till January 2015. Okay. For $9.50. Now, some of that is guaranteed to come back to him. In fact, most of that $9.50 is guaranteed to come back to him. We're going to do a little what I call the 5-line setup to solve for what won't be guaranteed back. Okay. All right. So $58.95 is what Mike has invested, and $55 he's guaranteed to get back because that put option is a strike price that's higher than where the stock was trading. Okay, so $55 he's guaranteed to get back. Now, what does that make as a difference? The difference is $3.95 is how much he could lose if the stock goes down. And that's represented by this red water down here. Now, as far as his upside, that is unlimited. Okay, but his at-risk amount is 6.7% of what he's got in this trade, or $3.95 a share, or $395 per 100 shares. Okay? All right. Now, you might have looked at that and thought, hey, that seems backwards, because the way that a married put is usually practiced is that they'll buy the put option that's just a month away, and they'll also buy it what they call out of the money. Out of the money means that rather than spending a lot of money on the put option, they'll spend a little. If the stock is around $50, what they'll do is they'll buy a $47.50 or a $45 put option, which will cost less. But I want you to look at something. A lot of folks believe that buying that put far away and in the money would be expensive, but it isn't. You see, the in the money portion of that put option, the difference between where it's trading today and what the strike price is, okay, that's guaranteed back. Mike will receive that back no matter if the stock goes up, down, or sideways. He will get the in the money portion back. The out of the money portion is what he's risking. And the time value in a put option or a call option, time value in any option, falls off slowly at first, but it speeds up rapidly towards the end. Now, Mike doesn't have to hold this for 10 months. If you recall, he bought in March, he bought a January put 10 months away. Okay, but he may decide to just hold it for a month. But if your intent is to only hold for a month, it doesn't mean you have to buy a put that's 1 month away. Okay, so you would still buy a put that's far away, and here's why. On this chart, we've got 120 days remaining, 9 days remaining, 60 days remaining, etc. The amount that the time value decays is only a slight amount between 4 months away and 3 months away from expiration. So why would you buy a put option that's going to decay rapidly, really quickly? And that's what most folks do. Most folks buy a put option that's 1 month away, and they buy it out of the money, so it doesn't really afford that much protection. The way that we do it with radioactive trading affords more protection, and while it's giving you more protection, it also allows for greater growth. Okay? Now, to confirm the truth of what I'm saying, I would like for you to think back to your record. Would the radioactive profit machine change it if you had a put option protecting you so that you couldn't possibly lose more than single-digit percents last year, but your upside was unlimited? Would you have done better? You could have the same picks and the same timing, but you had no losses greater than, say, 5%. Okay. Now, I know that Mike's example there, it looked like 6.7%, but really the way that Mike's going to manage that, he's very likely not going to hold that put for all of its duration. He'll get out earlier. And because he can get out earlier, he doesn't even risk the full 6.7%. He's probably more like risking 3, 4, 5%. Okay? All right. Now, what's so different now? Well, what's so different right now so far is skew. We've introduced skew to where that stock has no limit to how high it can go, but it can't hurt you by more than just a few percent. So that old trader's maxim of cut your losers short and let your winners run is actually being put to use. But there's more to it. There's more to it. Let's talk real quickly about a pair of trades in Mike's record. In a 1 year period, Mike traded hundreds of trades, okay? But I like to compare these two because they have such a wonderful comparison, okay? Mike got into SLW, got into 300 shares and 3 put options, and he ended up making 58.9% on his money. Now, the 58.9% on his money isn't just the 300 shares and the 3 puts, but it's the 300 shares and the 3 puts and funds that he was able to add afterwards with zero risk. Now, that sounds a little backwards. We have an income method called income method number 4, nicknamed the ATM machine. Now, what do you got to do to take money out of an ATM machine? Got to put it in first. Well, Mike was able, because of the gyrations of the stock, he was able to use an income method number 4 play 3 times. And he continued to add funds into a winning play so that finally, by the end of it, he got out 58.9%. Now, get this. he only had single-digit risk at the beginning of, say, 7%. And he was what we call bulletproof 1 month in. Now, I'm going to show you bulletproofing in a minute, but after bulletproofing himself, he stayed in for another 4 months and ended up taking out nearly 60% of every dollar that he put into this play. Okay, so it's several $1,000s with an only $6,450 investment. He took out several $1,000s afterwards. Okay, now that's not impressive when you consider just the gain. Let's consider the losses. Mike also had a stock called Talisman Energy. And it says position, but it's not his TLM position. It was his TLM stock. TLM, Talisman Energy, lost over 50% while he was in it. But his loss was only 4.5%. Why? Because he had a put option in place, and he also used an income method, which I'm getting ready to show you. Okay? He also used an income method. So when the stock goes down, he loses 4.5%. Now, you might be thinking to yourself, oh, poor baby. But now you're going to get mad. And here's why you're going to get mad. That's his biggest loss of the year. His stock went down by 50%, and he took a 4.5% hit. And that's tiny. Okay, that's less than 1/10 of what his loss should have been. All right, but that was actually his biggest loss of the year. Okay, 4.5% hit. So when you have losses of 50% and gains of 100%, we saw this earlier. When you do that, you never get ahead. Okay, because you keep cutting in half your double. Right, you double your money, then you cut it in half. Double it, cut it in half. Double it, cut it in half. Okay, but when you have something like 4.5% losses and 50.9% wins, you do very well. Now, this equation here is an equation that the casinos use, and it's called expectancy. It's number of wins times the average win minus number of losses times the average loss. And their job is to keep you either having a greater number of losses or a greater amount of loss. Believe it or not, what I've shown you is the way to control this number absolutely. Control this average loss. And if we change this loss from what it could be into a very small amount, we've handled the whole equation for expectancy. If this number is greater than 1, over time you can expect to win consistently. Even though you'll have losses, over time you can expect to win consistently. And this is what's happened with Mike. You know, when you have losses of 4.5%, and that's your greatest loss, and certainly the 58.9% win is unusual, but you know, he had a number of double-digit wins, right? Well, when you have double-digit wins, and but your losses are always single-digit, you're going to get ahead, okay? Especially since Mike has been able to choose winners more often than losers. Okay, so what's the difference now? We already talked about skew, but what else is the difference? Well, I'll show you. We can, within the context of this radioactive profit machine, we can also generate income, okay? And we can generate income 12 different ways so far that I've discovered using the income methods. Okay, so what I'm going to do is I'm going to share income method number 5. Using the income methods, you can reduce your risk or take income or do both. And it enhances the skew of your radioactive profit machine. Here's our theoretical example where we have the cost basis as this dotted line and the strike price as this bottom line. Okay, so if the stock goes down, the most that we could possibly lose is the difference between those two. Well, what if we were to take that difference and reduce even it? What if we were to reduce it to where now we could lose even less? Okay, so we're enhancing our skew. We're able to actually see that stock do even better, and if it reverses on us, have it do even less damage when we have a problem. Okay, all right. So here's what Mike did. About a month into the trade, he used income method number 5. And income method number 5 goes like this. He sold to open 2 May $55 call options at $1.50 a piece. Now, since he's selling 2 call options, he generates $3 in premium. Okay. Now, he used some of that premium to buy to open a May 5250 call option. Now, I want you to keep in mind the fact that Mike is in a stock that is protected by a put option that's all the way out till January of the next year. Okay, so this is a near-term play. He's doing it in April, and it expires in May expiration. Okay, so the amount that he's captured here is 40 cents, and we call this a ratio call spread. Just this play by itself is called a ratio call spread. Okay, we call it income method number 5 because it's something that's done within the context of another trade. And that context of the other trade is what makes it riskless. The ratio call spread itself is normally with infinite risk. 40 cents is received on the front end, but if CAR ends up above $55.40, we're going to have the obligation to deliver shares at $55, and we're going to have to go out on the open market and buy them at whatever they're trading to deliver at 55. So we would start losing money normally. Here's the graph of that. We're collecting our 40 cents on the front end. And by the way, if the stock goes up a little, not a lot, but if it goes up a little, we might have the opportunity to get paid again. But because we've sold 2 calls and we've bought one of those 2 calls is naked. And what that means is we have the obligation to deliver shares of stock, but we don't have shares of stock. That's what the ratio call spread does to us as far as the infinite risk. But I want you to consider something. I said that I was going to show you a riskless spread trade, and this is it. It's riskless, but it's riskless not because of the way that we've arranged it, but because of the context. You see, the context is, hey, we own the stock. If we own the stock, why then 100 shares could be supplied by this 5250 call, this 5250 call, and another 100 shares could be supplied by, well, us. We've already got the shares. So all this red water on the bottom goes away. We can't possibly lose capital by doing this play. Either the stock stays below 55 and we keep our 40 cents, or it goes above 52.50 and we make a little bit more. But if the stock goes above 55, hey, we're going to deliver it at 55, but we own it already. We own it at a cost basis of $49 and change. So happy day, right? Okay, so here's what happened. May expiration came, and just like in a cover call play, if Mike was just to leave those short calls in place, his stock could be called away. But he wanted to keep it. And during the day on expiration Friday in May, during the day, his stock was at $54 and change. And by the end of the day, it was $55.16. Okay, so he would have gotten called away. Well, what he did was he closed the play on expiration Friday. He decided he wanted to keep his car. So what needs to happen? Well, he needs to buy to close those short calls. By the way, he also happens to own a call option that he was paid 40 cents to own. Do you remember this? He bought 1 call and sold 2 against. So he was paid 40 cents to own this call, and now he's able to sell it for $2.35. And he's still got to close those May $55 calls. And on expiration Friday, before the stock went above $55, he was able to close them for 15 cents a piece. Now, if you waited till the very end of the day, it would have been about the same. Maybe it would have been 20 cents because the stock closed at $55.16. Okay, so anyway, he closes those by buying to close 2 calls at 15 cents a piece, or spending 30 cents. Okay, times 100 shares, that's $30. Okay, or times the contracts, it's $30. But here's what happened. He ends up with a second credit of $2.05. When you think about it, that's pretty darn cool. Okay, that's 40 cents to get into this play that we call the money net, or income method number 5. Okay, 40 cents to get into the play, and $2.05 to get out of the play. or a total of $2.45 captured premium. Now, if you recall, these $55 calls had been selling at $150, and if he decided he wanted to keep a stock, he'd have to spend the 15 cents. Okay, so that's $150 in minus 15 cents out equals $1.35. So with just a plain vanilla covered call play, he would have collected $1.35, but because he did the money net, he collected over 80% more, $2.45. And a lot of folks will look at that and they'll say, hey, what about commissions? Well, what about them? You know, you'd have to pay commissions on your covered call play too, both on the sell side and on the buy side. All right, so it actually makes this an even better comparison. Okay. Now, here's what happened. Mike started with a play where he could possibly lose the difference between the $58.95 that he spent and the $55 that this put option guarantees that he can exit. Okay, so the difference between the $58.95 that he spent and $55 that he is guaranteed to get out, that's $3.95. Well, guess what? He just collected $2.45, which offsets that. Okay, so instead of having the potential to lose $3.95, now he has the potential to lose $1.50 per share. Okay, on the downside. And guess what? The stock kept doing things that were agreeable. It kept going up and maybe retracing a little bit, and then coming up a little bit again, and then retracing a little bit. But during those times, Mike continued applying income methods and offsetting the cost of his put. So, eventually he's what we call bulletproof. He's collected more premium than he has spent on the time value of the put. Well, the thing is, Mike did end up with a double-digit return on CAR. But the remarkable part is that he never had more than 6.7% at risk, and even that is conservative. It's really more like 4.5%, 5% at risk. Why? Because he could get out early. You see this red line here? This red line shows the early liquidation of the stock in the put. Why? Because there's time value in that put option. The blue line is at expiration, on expiration Friday. Okay, so pretty cool. Income method number 5, or a ratio call spread, within the context of your RPM, does not risk any capital. You generate credit, but it can't come back and bite you. And that's really exciting, okay? Here's another thing that's really exciting. You don't have just this one. There's 12 different ways to apply income methods to either lower your risk or lower your cost basis, or both, okay? You may end up with a married put with all the time value paid for, and your upside is left intact. So, kind of cool. Exciting. We call this situation bulletproof, and it's our goal. Now, a quick reminder, you may not get all of this in the first viewing, okay? You just might not get all of this in the first viewing, and that's okay. You want to use your support. Now, I'm also going to mention you probably want to pick up the blueprint or the home study kit. You'd probably want to pick up the product that will teach you all 12 of these adjustments. I've only shown you just the one. Okay? Now, Power Options is offering a special. It's 2 free weeks of Power Options for just your name, and no credit card is needed. Okay, no credit card will be billed for your 2-week trial. All you do is provide your name and email address, and go to this address, www.poweropt.com/RAT for radioactive trading, and you'll get a free 2 weeks. Okay, and then again, no credit card is needed. Now, bulletproofing your stocks with options. This is something that I was going to do for my live audience, but I can't, okay, because my live audience isn't, you're not live, okay? I'm doing a recording, okay? So I was going to say, hey, let's explore the idea of bulletproofing your stock positions. Well, that's certainly possible for us to do. What I'm going to do is jump over into this custom spread builder over here on Power Options, okay? And I'm going to look at Facebook today. All right, we'll just look at Facebook today. And here's our risk. It's about 5%, $442 at risk. And we're getting a put option clear out till October. All right, so once you look at those numbers again, we've got 442 at risk. This is, what is this, May 19th. By the way, I'm not making a recommendation. I'm doing a demonstration. Okay, this isn't a recommendation. It's a demonstration. If you wanted to pick up Facebook, here's how I would do it. I would buy the stock, but I'd also buy a put option so that the most I could possibly lose is 5% or so. Okay, now, I'm going to go up here and I'm going to apply an income method. And the income method that I'm going to choose for this demonstration is income method number 6. Okay, income method number 6 we might use to generate a little bit of premium right here and now, where we would sell the $81 call options and in their place buy the $84 call options. Okay, and so that's what's called a bear call spread. Now this is going to also be riskless. It's a riskless spread trade. Oops. Let me scroll down. When I press submit, it will grab the natural ask price and the bid price. You could probably get filled at a better price than this. Okay? All right. But let's just say that this is what we've done. Now, the risk had been $442, hadn't it? But now it's $332. Okay? And what happens is either, by the way, the maximum profit is infinite. It could still keep going up. It could still keep going up. You know what? That wasn't the best example. I'm going to do another example instead. Let's do the June. One of the best things about having more than one arrow in your quiver, so to speak, is that you don't have to choose just one income method. I'm going to do a different play here. And what we'll do is we'll sell the 83s and buy the 85s. And this is a different income method. Okay, and you'll notice that what I've done here is I've reduced my risk. Well, reduce the risk by what? By taking a credit. The credit that we took here was 107 by 57. What we've done here, if you'll notice, we still have unlimited upside potential, but our downside is even more limited than it was. It had been limited to $442 or something, and now it's limited by even more. If I just did this play by itself, this bear call spread, I would collect 50 cents, but I'd have $2.50 at risk. I could actually lose $200 on this play. But you don't lose the $200 on the play if you happen to be doing this in the context of already owning a stock. Okay, so anyway, don't mean to cloud things. We've already looked at skew and limiting risk, but the idea is why don't we take our positions and reduce our risk even further? In fact, you can reduce your risk until finally bringing that gap down further and further until finally you eliminate the gap. And now we've got what we call a bulletproof position. Okay, kind of cool. This phenomenon of bulletproofing is just plain sexy. Okay, all right, so what to do next after this primer on limiting risk and bulletproofing stocks? Well, here's what I would do. Okay, what are the next steps I should take? I might jump into another presentation and show you something kind of funny. Okay, but I would like for you to do this. I'd like for you to take a look back at your trading record and ask yourself this question: would the radioactive profit machine change your record? If you had the same picks as you did last year and got in and out with the same timing, but you had no losses greater than 5%, would it have been a better year? Most people say yes. In fact, many people say that would have changed a losing year into a winning one. And others that were winners said that it would have taken their winning year and made it an even greater year. Okay. Number 2, consider how different things might be if you also took income. Did trading covered calls limit your upside? I've just shown you a way to eliminate risk and then remain in the position for months and months, if you like, without any risk. Okay, so were there any instances in which you could have gotten a better return if your stock just continued up and you didn't have to part with it by way of your covered calls? Well, yeah. I mean, if that was the case ever, think about your upside perhaps being better than it otherwise would be. Okay? Number 3, I'd grab a free trial to Power Options, and we already gave you this link, okay, to Power Options, powerup.com. You get 2 free weeks, and you can try it out. Okay, this is the tool that I use to find these kinds of trades, evaluate them, and take a look at whether or not I want to change it. Take a look at whether or not I want to introduce a nested trade that would change the outcome. You saw me do that earlier. I did a change. I didn't like what I saw, so I did a different type of change. Okay? All right. And you'll want a private consultation so that you can set this search parameters to exactly your liking. Okay? All right. Now, finally, if you think you'd do well to learn the other 10 income methods, because I showed you number 5 and 6 today, briefly on 6, okay? But I would pick up the home study kit or the blueprint, okay, at radioactivetrading.com. Now, here's something that's kind of interesting. I'm going to go ahead and jump out of this presentation. I'm going to jump into another one, okay, because I wanted to show you this. This is just kind of funny, okay? It's possible not just to bulletproof your stock, but it's relatively commonplace. By using the income methods to whittle away the cost basis of your insurance, the best part about it is that while you're doing riskless spread trades to capture income, you're also sitting on a stock that could potentially go way, way up. And I did this with Marvel. Marvel Comics is something that I was always a fan of as a kid, and I invested in Marvel. And as I was investing in Marvel, I happened to make myself bulletproof. So I'm sitting on a stock that can't possibly lose. And during the time that I'm sitting on that stock that can't possibly lose, Disney makes an announcement that they're buying Marvel Comics. And so my stock shoots up. And get this, if I had sold a covered call against my bulletproof stock, the most upside I could see is, 3, 5, 6%. What I saw instead was a 30.2% profit on my invested dollar while I can't lose any money. How sexy is that? That's kind of cool. It's even sexier than this guy here. All right, having a bulletproof married put where the downside is completely protected, but the upside is unlimited. Boy, that's something else. Okay, so how about it, guys? Would you like to learn more income methods? One thing that you could do is you could keep coming to these free webinars because I give away some of the income methods. I don't necessarily give away all the ways to choose them and the ways to manage them, but I do show them as demonstrations, okay? Way back when I was teaching just 9 income methods instead of 12, we actually had a fellow on the East Coast, a medical doctor, contact us and say, hey, thanks for the information that you shared at the free webinar. And I was saying, wow, yeah, you're welcome. He said, I just made over $900 profit on Visa card, after I bulletproofed it using income method number 4. And I thought, wow, cool. He went to one of my webinars, and for free, he learned enough to go ahead and bulletproof one of his positions. And then he turned around and made $900 with it. And everything was awesome until I got to this part. And he said, I've been coming to your webinar since October of last year. Now, guess what? This was November of the following year that he told this to me. So 13 months, all right? 13 months he's been coming to the free events. He says, you've only showed income methods number 1, 3, 4, and 9. So when are you going to be doing 2 and numbers 5 through 8? And I thought, dude, seriously? I mean, really? We actually looked up his attendance record, and he had been to 86 webinars, most of them more than an hour in length. And I thought, oh my gosh, he made $900 after bulletproofing his Visa stock using just one of the income methods, and I wonder how much he lost out by not knowing the other income methods. Just by trying to get them free instead of ponying up the tiny fee, relatively speaking, for the blueprint. That's 90 hours of webinars to try and get all the income methods in your head for free. And I don't know what medical doctors earn, but it's probably more than $6 an hour. Okay, so I thought that was just kind of funny, ridiculous funny. Anyhow, time to discuss the price of the blueprint or the home study kit for you. And perhaps, more importantly, the cost of not owning it. Now, this is a prepared slide. I'm willing to bet you that some of the blueprint techniques would have made a difference to your portfolio of over $500. And normally in the live class, I do a poll, and I find that out. Okay. Now, some of you said some folks that I've polled live have said over $5,000. All right. But do you think that you might trade for more than 10 years or so? There's one fellow in Colorado Springs that did one of my live sit-down seminars, and we went around the room. I said, hey, how much better would you have done last year if you'd have known what I just showed? And, 5,000, 10,000, 15,000. And finally, this fellow was left with his hand up at $30,000. And I said, wow, so you would have done $30,000 better last year if you'd have known this stuff. And he says, no, not exactly. I would have done $30,000 better in one trade. Okay, so the cost of not owning the blueprint, consider that. Okay, if you could have done $5,000 better in 1 year, that would be $50,000 over 10 years of trading. If you think your trading career is going to continue for another 10 years, that'd be a $50,000 value. Okay, the Colorado Springs guy said, hey, it was $30,000 in that one trade. What if you only would do better by $500? That would be over a 10-year period. That'd be $5,000. Well, guess what? What the blueprint really costs is not $5,000. Okay, I don't charge $5,000, although I would have a clear conscience doing so. Half off would be $2,500, and again, clear conscience, clear as a bell. But that's not what we're going to charge. $1,250 would be half of that. And yet, I'm not going to charge $1,250. The home study kit with the blueprint and 6 video CDs is $599. Okay, $599 for the home study kit. And this is the best offer that we've got going and the best price at which the blueprint will ever be made available. Okay, if you go to radioactivetrading.com/iridium, you'll get the very best price that's available. Okay? All right. Real quick, I'm going to pull up this other slideshow. And the blueprint is available at $339. And if you go to that link that I showed, www.radioactivetrading.com/iridium, you'll get 5 bonuses that I don't have the time to discuss here and now. Okay? Let me show that slide again, and we'll wind it up for today. I want to thank you for coming to today's webinar. Whoops, wrong one. I want to thank you for coming to today's webinar. Sorry about earlier today how it didn't work out for my live attendees. And so we're just going to make this available here. www.radioactivetrading.com/iridium for the blueprint or the home study kit.